All right, so we ready to get started? All right. How many fishermen do we have out there? All right, you know how important it is to fish in the right pond? Well, if not, let me introduce Mr. Eddie Speed.
I ain't here for a long time. I'm here for a good time.
There you go, George Strait. I'm a country boy, y'all know that? I grew up in a cattle auction barn in Jackson, Mississippi. That's where I learned to work hard. When I was a kid in high school, I used to get out of school a little bit early. The big sale was on Tuesday, and in the fall is when they would have the biggest cow sales. And I would go work the sale ring behind the auctioneer. He would speak right over the top of my ears, and I was the guy that moved the cattle around inside. And I was around a bunch of professional cow buyers, and so it's funny, they would go to cow sales every day and buy cattle. And a cow buyer would look at, they all knew each other, right? They knew the auctioneer, and they never raised their hand, ever, never. They would have like a pin card, and they would look at, they were making eye contact, and they tap that the card that would list the cattle that they were buying. They just had kind of a long piece of paper, and they would hit that thing. That meant you were in. And you'd go to the horse sale where people weren't professionals, right? They were just mom and pops wanting to go buy a horse for the kid. They would raise their hand and stuff like that. My dad used to tell a funny story. He said, I went to a horse sale one Saturday, and I smoked a cigarette, and I bought 3 horses. Oh. You know, this topic has probably been the least addressed topic in the industry in the last many years. And it's probably one of the most critical topics that we could talk about. So, a lot of you that have heard me speak before, I draw 2 distinct lines in the business. There's fee income and there's long-term wealth income, okay? So fee income, one of the ways you could earn fee income would be to go, essentially flip a note, just like you flip a house. I flipped well north of 20,000 notes, meaning I never had the money. I'd have the money lined up, Associates, Metropolitan, Bayview, and 40 other institutional investors over the years. And they would fund, the money would be in escrow at the title company, and they would fund the deal, and then I would go buy the note and simultaneously resell it. I was flipping a note. That is a good business, but it is an income business, and it's not a wealth business, right? And so I don't want anybody to think that I'm poo-pooing that. We are a funding source in the note business, our company is, as of several other vendors down there, that's what they do. And I think that's a good business. But I've always learned, if I really had an influence and a guidance over the industry, I've always learned that one of the most important things that I could really encourage you guys to do and help you figure out how to do would be how not to make just flipping income. And part of that would be you also make wealth income. And for most of you to do wealth income, that means you eventually are going to have access to passive investors. And what's happened, I've noticed, is there is not clarity among people in the note business of what is passive and what is active. They're not clear about this. And this is a point that I think is really critical. So I hope this helps you. I hope this gives you a vision. And we're going to talk a lot about today, which really just becomes nothing more than your belief system. If you think you can, you're right. And if you think you can't, you're right. Who was that? Eleanor Roosevelt? So the note business really is about 2 components. The first of which is if we were at a big event, IMN, a 5-star, a mortgage bankers, all the guys from New York City that talk like this and don't smile much, they would say it's your capital stack. And all that really means is where your money's coming from, okay? But that's what they refer to it as, is your capital stack. And the second thing is your asset class. And really, if you just break the business down, there's two separate areas. And what I'm really trying to say to you today is there is a balance in this business. And I see some people that spend way too much time working on the asset class and way too little time working on their capital stack. I see people working on their capital stack all the time and not enough time managing the assets that need to be managed. So the asset class and the capital stack really is a balance. And we'll dig into both of those topics. 2014, non-performing notes were still pretty cheap. They weren't as cheap as they were in 2010, but they were pretty cheap. And investors could buy non-performing loans cheap enough that they could pay an inordinate return to a passive investor, right? And in that era, there was enough inventory, about 12 million, in non-performing notes that you could there was a big inventory and you could dig as big as your shovel was, right? If you had a big enough shovel, you could dig deep enough, and people didn't spend as much time looking for cheap money. They just found available money. In fact, investors, passive investors, and quite honestly, they kind of got spoiled, right? In the same era as this, you had competing businesses, apartments, okay? Listen, there's a lot of apartment syndicators, a lot as in a lot, that have never even lived through a cycle. I mean, they've never lived in a market when the market dropped. Yet they're raising millions of dollars from passive investors and borrowing tens of millions of dollars on apartment complexes, and they're not even seasoned enough to live through a cycle yet. Listen, anybody can be a genius when the market takes care of you. Let's just agree on that. And so investors have had some really lucrative times back from 2010 to around 2014. They had some really lucrative times. And a passive investor could earn a pretty dang good yield. It wouldn't be uncommon a passive investor could have earned 14 to 16. And you almost assuredly could have earned 12. And it was because the asset class availability was perfect for the market conditions. Apartments were going up, and notes were cheap, and the workout side of notes produced a very lucrative opportunity. And what happened in that, I believe, is that we did not train an audience of investors, note people, us. We didn't train the audience to go source cheap money. We put all of our focus on asset management, asset acquisition, buy low, sell high, right? We didn't go find cheap passive money. Now, there was plenty of money available in that market. You see, the stock market debacle drove more investors to alternative investments than any other time in the history of America. There were, from 2009 to 2016, there were 5 million REO properties sold. Who bought those properties? Who bought those 5 million bank foreclosed properties? Anybody got a clue? Hedge funds bought 4%. Private investors bought 96%. Hedge funds did not take your inventory away. Passive investors took your inventory away, right? One of the industries that's blossomed like crazy in that era was called turnkey properties. right? Done for you at properties. You could live in California and buy a property in Memphis, Tennessee. It was rehabbed. It was loaded with a tenant, a management in place, and you just buy it, and you could get leverage on it, and you just make your investment, and it just was a done-for-you investment, right? In that era, they did way more turnkey properties than the hedge funds ever thought about buying. Way more, like 5 times more. So what I'm saying is the market fills its gaps. Now, investors did not run out of cash because they bought 5 million properties. In fact, we went through an era where there was more dry cash, uninvested funds. We went through an era for year after year after year after year where there were so many trillions of dollars in uninvested funds, just uninvested. People were scared to put it in the stock market. And why didn't they invest it in something else? Why? They didn't know what to buy. And what was interesting to me is, do you know who bought the turnkey properties? Do you know who bought a majority of the turnkey properties? People that went to real estate seminars. That's who bought them. That's how they found out about them. You know who one of the biggest sellers of turnkey properties is today? It's a training company called Fortune Builders. Wow, things got really quiet, didn't they? So it's interesting is not, it wasn't the doctor, it wasn't the dentist, it wasn't the engineer, it wasn't the self-employed high-income person that absorbed most of these properties. It was absorbed by people that were hanging out looking for property, and then they figured out it was a lot of dang work. And that same investor, am I right, Lisa? You live in San Jose, California. I've spoken at that RIA many times out there. It is full of people doing exactly what I just described, isn't it? 95% of the people at that RIA do exactly what I just described. I've spoke all over up and down the coast. I've been to many real estate investor clubs all up and down the West Coast, and it is full of people that have done nothing but buy turnkey properties all over the Rust Belt and the Southeast. So the thing that I would say that I started noticing, and this is what really made me start realizing it, is turnkey providers never went, if you were in Kansas City selling turnkeys, you never went to the local real estate investor club in Kansas City to go sell your turnkeys. Why not? It was the expectation of the investor. You see, in California, you could sell a turnkey house in Kansas City or Memphis at an 8 cap. That means if you paid all cash for the house, take the net income of the house, and you would earn an 8% return on your investment per year. Pretty simple math. If you paid $100,000 cash for a house, you could earn $8,000 net income on that house in a year. Okay? That's a capitalization rate. But in real estate, in fact, the turnkey industry never called it a cap rate, never recognized the term a cap rate. They called it an ROI. It's your ROI, return on investment. In fact, if you're selling a turnkey house and you're selling to typical trained turnkey buyers, they're all going to be very familiar with the term ROI, and they'll have no clue what you're talking about if you say cap rate. It's the exact same thing. It's just terminology, and that's how they messaged it. I Googled cap rate one day. I guess I know why they now refer to it as ROI. It's pretty confusing to me, and I thought I knew what it meant. The way that I'm setting this up, though, the way that I'm setting this up for you is to understand is there's 2 ponds in our business. There's passive money and there's active money. Okay? Not passive activity money. There's passive money and there's active money. And too many people in the note business are not clear about this. And they are overfishing in a pond that has people that want active money investments, not passive money investments. So let's just get real. If this was the yield a passive investor could earn, this is probably more realistic today. And by the way, my wife almost never sells a partial at 8% yield. That's too high. Okay? It's too high. So that really is what I believe the market situation is today. It's not about greed. It's about deal flow and asset class that's being offered in the market today. Let me just be clear about this. If you're an investor buying non-performing notes, they no longer cost 28 cents on the dollar. They now cost 58 cents on the dollar. Okay? And you can't give the same yield to an investor that you could in 2012 unless you just decide to cut your salary to nothing. Right? That's just a market condition. And a lot more money is flowing now today into performing notes than money is flowing into non-performing notes. A lot of opportunity in performing notes, but to really do the business well, you're going to have to be successful at sourcing passive money, not active money. So therein lies the name of the presentation. What pond are you fishing in? Are you fishing here or here? And it's the doggone truth. It's the doggone truth in this business that too many investors are fishing in this pond looking for 11-pound bass. And he ain't swimming in that pond. You might get you a mud bug. Y'all know what a mud bug is, don't you? How many of you ever eat them, they grow them things in Louisiana called a crawfish? Okay, well, let me tell you something. I'm a boy that was raised in Mississippi, and I've been around a many occasion in my life. In fact, I know the family that is the largest crawfish grower in the world. They call them mud bugs in Louisiana. So when you go to a restaurant and they serve crawfish, you order mud bugs, and you'll figure out if the waiter knows what they're doing. So I want to ask two questions for yourself to really kind of analyze your business. Two questions. First question is, how mature is your business? How long have we been doing this? How long have I been doing it? Long time. Okay? Should I have contacts in the business? Do people know who we are and people know what we do? So do we have an advantage over somebody that just started? Okay? All of you that have been doing it a year have an advantage over somebody that's been doing it a week. All of you have been doing it 5 years have an advantage over somebody that's been doing it a year. Your connections, your contacts. Now, if you haven't worked smart, you haven't warmed all these investors up to every situation. The second thing is do you invest, how much time do you invest sourcing capital investors? Y'all know we have a training business, right? Can you believe sometimes that I have students that can't follow instructions? I mean, does this seem possible? I know, it seems crazy. I had a student, you can't make this stuff up. I had a student, I tell my students over and over and over, do not go to the RIA looking for 6% money. They're spoiled. They're spoiled. They're sitting right next to you, and they're listening to some guy on stage tell a story about earning 20% return, and now you're going to rub them on top of the head and tell them 6 is good. It ain't going to happen. Lisa, if I went to your RIA in San Jose, I could tell an investor an 8% return is good, and I could raise a boatload of capital. If I went to the RIA in Raleigh, Tim, I couldn't raise a boatload of capital if I offered 12% return. So one of the things that I have made a clear observation of is that if you're going to get cheap money, you got to get outside of people that have been sitting in the same seat right next to you and hearing the same propaganda that you've been hearing. You got to find somebody that don't know where to have a deal and they don't have an expectation. Now, most people that are sitting on dry cash that show up at the real estate investment group, quite honestly, never get their money invested. They want to earn 14% return, and you see them 6 months from now, and they're still looking for 14% return. And then you see them a year and a half from now, and they're still looking for 14% return. But the problem is they have gotten an expectation in their head, and my life experiences is I have had a very difficult time breaking that expectation. And so I just decided that's not a pond I want to fish in. Now, I go to real estate investment groups just like you do, and I do a ton of business there, and I find a ton of students there, and I find lots of opportunities. I'm not telling you not to go to real estate investment group. I'm saying to you that is not where you source your cheap capital. Are we clear about that? So where do you source cheap capital from? You don't source cheap capital sitting by somebody listening to a real estate guru on stage telling you you're gonna earn an incredible return on your investment. Right? That's not the right environment to go find somebody that just here's the money, take the money, please. Now there's some people as I look across this audience today, they're really, really, really good at sourcing cheap money. They are operating with a selling system. They have a selling system that involves raising cheap capital. I've done my fair share of pitches on stage, pitching to investors. Investors do not hand you a check at the end of the presentation. This isn't throw the credit card over the desk and buy my $1,000 product. It ain't that deal. Investors always hand you their money 6 months later. And here's the real deal. It's a warming process. It's a warming process. Investors never give you all the money they have the first time they give you money. And they never give you their money immediately. And by the way, if they give you your money immediately, it's just been my life experience that, to be truthful with you, they don't make great investors because they will wear you out. You don't need another job on Monday morning except talking to them. And so I have just noticed this pattern that if you're going to be really, really good at raising cheap capital, you have to understand what the selling cycle looks like. You can't have an unrealistic expectation. So I have a student, I was going to tell you this story. I have a student that I'm on a phone call with. This has been a month or two ago. Nice fella. And he goes, Eddie, I just haven't been able to raise inexpensive money. I said, where are you going to try to raise inexpensive money? Well, mainly I've been going down to the real estate meetups and the investment groups. I said, I already told you that won't work. I said, you're wasting your time. I said, that investor is never going to be satisfied at the 6 to 8% return for a passive investment. He's going to be satisfied with a 12% return or a 14% return. He said, I know. He said, but I can have a lot of people to network with there. And he said, I tried to have my own meetup, and he says, it just sort of broke my spirit. He said, because I had my very first meetup for passive investors, and I had a party for myself because nobody else showed up. And I said, well, most great success stories I know that start out raising capital start out with some failures. And I said, so expect to fail some to start finding success. My friend Mitch Stephen on stage yesterday, I've known him forever. He has about $15 million of doctors and lawyers and Indian chiefs' money, private investors, passive investors. He's been doing it for years. I remember when Mitch first started doing it, and I remember very well Mitch had his first meeting and had about 2 people show up. Okay, so expect some failures before you get to some success. But you need to find passive investors that need the opportunity to invest some money. I'm partial to doctors. I'm partial to dentists and doctors because I hear more success stories from more people than that thread than any other single thing. When we had our case study competition, for those of you that aren't in our long-term membership program, we had a special day here a couple of days before, or a day before NoteExpo. And in the case study competition, we interviewed the finalists and we said, how did you find the money? And the story kind of worked like this over and over and over. Well, I got a group of doctors. Well, I went to the foot doctor. I've sold a loan to him, and then all of a sudden he's got other doctors. And the story just was contagious with the same thing over and over and over. That looks like a good pond to fish in to me. That looks like a good pond to fish in to me. Passive investors with an active mentality. That's them. Now, if you're really a cowboy, that is not referred to as a coyote. That's what city people say. That's a coyote. Right, Russ? That's a coyote. That ain't a coyote. If I went out in the country and referred to a coyote, they'd slash my tires. That doesn't mean that they're a bad person. It just means that they're on the hunt for a deal, and to be perfectly honest with you, they're in a mind zone that I don't think the current market conditions really provides. You could be a coyote investor, passive coyote investor in 2010, right? I don't believe the market yields you that investor today. So all of us have dealt with this guy, right? I'm not saying that we never have, and I'm not saying he's a bad guy or he or she or whatever. I'm just saying that is what they're looking for. And they have a yield expectation in today's market of 12 to 18%. Last year, here at NoteExpo, I go sit down at a round table during lunch, and I did exactly what Bob and all of us tell you to go do. I went and set a table where I didn't hardly know anybody at the table. I maybe knew one person. So I went and found a table that wasn't my 12 best buddies, and I sat down with an investor, and he says, I'm an investor, and I invest in notes. And I said, okay, well, how do you find them? He says, well, I don't. I partner with people that find them. I said, okay. I said, and so do they do all the work? And he said, yeah. I said, so you're the money and they're the work. He said, yeah. I said, what kind of return you get for that? He says, minimum 16, hopefully a 20% return. I said, well, mister, you don't know me, and I don't really know you, but I have a lot of experience in this business. And either you have an amazing partner or you're in for a surprise. And I hope he took that in the right way. Because all I was doing was speaking to the future that I was pretty sure was going to happen. And maybe I didn't have the right to do it. Maybe he's not back this year, I guess. But did I tell him the truth? I told him the truth. So I always think that I want a passive investor with a passive mentality. Now, I use these images not to make fun of investors, but to give you something to resonate with. So I'm looking for this old boy right here. I'm just looking for a happy little rabbit that says, put the carrots right there in front of me, and I'm going to sit there and munch on my carrots. I'm looking for rabbits, not coyotes. A lot of people spend a lot of time and energy sourcing private capital to fund their long-term business, and they're attending coyote parties looking for rabbits. That's what I've seen over and over and over. Now, I make a lot of money with coyotes. You understand that? I train coyotes, right? They're my buddies. But if I'm looking for somebody that doesn't want to go figure this out, they don't want to come to NoteExpo, they don't want to go to training, they don't want to go burn the midnight oil doing the business and due diligence and taking the risk that all of us take as investors, and they just want to be a rabbit, then they got to understand what they're going to get to eat is carrots. That's what's on the menu. Let's talk about asset class for a minute, because this does definitely have something to do with the possibility. Non-performing loans. Non-performing loans normally have the highest return. Why would that be true? Highest risk. It is called a risk to return ratio, right? And a non-performing note buyer today is going to have to be a smarter player than they were in 2010. Because the asset costs more, and you're going to have to be a lot better at squeezing all the juice out of the lemon. In fact, if I talk to somebody that says they buy non-performing notes today on working class assets, and they don't tell me that they use seller finance strategies to resell the house, and they don't use strategies like that, then I know they're probably not going to make the math work well. They're not squeezing all the lemon out of the juice. Let's just be fair about it. If your exit strategy is sell non-performing loans that turn into REO property, if your exit strategy is calling a local realtor and selling your inventory, you're going to die. And the math won't work, will it, Russ? Ain't going to happen. So non-performing notes, somebody that is in that asset class can earn a higher return, but let me be clear about it. There is a higher what? And it is a risk to return ratio. One thing that I always ask investors, frequently investors, the first 2 or 3 questions investors ask me is, so what kind of return can I get? And I say, what kind of an investor are you? They're like, what? I mean, what's your risk tolerance? Let's put you in an asset class that fits your risk tolerance. If you're looking for assured money where it virtually can't go bad, you can't pick the highest risk asset class and say, that's somebody that's chasing yield. Many investors that chase yield are unaware of the consequences of a failure. The second asset class, and that can be first, the price band of the assets and how you're going to exit the assets. In other words, if you had a machine where you could buy bulk non-performing loans and resell that loan one at a time, you might have an advantage over an investor that had no choice but to go long on every asset. Buy it, do all the work out, foreclose, resell it. So sometimes the way you exit those assets would have to do with how you could model that. In the performing asset, you've got 2 asset classes, and that is seller finance notes, which is a significant growing inventory, and another pretty big asset class and an inventory class are reperforming notes. Reperforming notes have a lot of possibilities in the market, but they're written at inordinately terrible terms. They're written at 2% interest for 40 years. So you can't walk in there with a 12% yield expectation and buy all the market would deliver. Now, here's the good news. You're buying a loan, even if you buy it at a lower yield, you're buying it at a big discount because it was rewritten at a low interest rate for a long period of time. Now, what do you think is going to happen on that note? It's going to take 40 years for it to pay out? Or what? It pays off early. So there's a way you could structure a deal with passive investors where where they got to share in some of that discount. They could put out their money at a lower return, but they could also share in some income down the road. So there's some creative ways that you could control some inventory in an asset class that's pretty plentiful. There's plenty of reperforming notes. You just can't buy them at 12% yield. The market won't tolerate it. So there's a lot of different scenarios that you could go do. Seller financing is a growing asset class. I have some big expectations on the horizon for seller financing. There's a good bit of institutional money entering the market that has an appetite for seller finance notes. And I smell it. I remember extremely well when Bob Repass was running Bayview and they were buying $400 million in seller finance notes a year. I'm not saying that we're going to be there next year. I'm saying to you that if I'm looking at the runway of seller financing, there's a lot of opportunity coming into the market. And every time there's opportunity for the big institutional investors, there's always opportunity for the smaller guy. There's a big inventory, growing inventory of seller finance notes coming on the market. And then the next side is real estate investor paper. Real estate investor paper is where you could originate seller financing, a machine, a cookie cutter. It's what I did for Homevestors in 1992. I've set up their note system. They had a franchise, and I said, if you make a note to this formula, then you can go sell that note. That's what took the note business from a low volume business to a high volume business. The seller finance note buying business, just buying from mom and pops, was never a high volume business. Teaching a real estate investor that did 100 houses a year how to create seller financing and immediately resell those loans scaled the business drastically. And there's a big future on the horizon in this area. Big opportunity. So these are the asset classes that I think generally for our industry exist. This is where the industry, the inventory exists or where it can exist. And if you can find passive investors that allow you to control the paper long term. I'm not taking away from flipping notes. Some days it's nothing better to do than go put some cash in your bank account. Flipping notes and make a profit up front is not sinful, it's smart. But you also want a diversity to your business, and you want to wake up and find out you're building long-term wealth. And the way to do that is you have to have a capital stack that's affordable. So what are the two things that makes your note business the most profitable? Assets you're buying and the price you're paying. You can't buy A-quality assets at a 14% yield today. That's just an unrealistic market condition. You can stumble into a deal, but you can't go build a business model around that. The investment environment today is not going to allow you to do it. And the next thing, other than the assets you're buying and what you're paying, is what we're talking about here today, and that is what we're referring to as your capital stack, how you're sourcing the money. So let me let you leave here with a couple of clear instructions on how I would like to see you progress with this. If you were going to build a house, what would you start out with? A set of plans? Make a plan. If you're going to build a business, make a plan of how you're going to work capital investors and make it a strategic plan. Let me just tell you this. They're not going to write a check to you the moment you meet them. They're not going to write a check to you the moment you meet them. Expect failure before you experience extreme success. In other words, right, Dave? Dave, you've been sitting there smiling. I've been telling your story for the last 45 minutes, hadn't I? Am I right? Let me tell you something. He's a good student because he went and did exactly what I told him to do, and he's now making it work. And he experienced failure before he experienced now what he is experiencing is extreme success. I told him to not let the coyotes come to his rabbit party. You had other coyotes coming to your party, didn't you? I said, send them home. He said, they're my buddies. I said, go fishing with them. They don't have, I said, Dave used to be a realtor. I said, Dave, if a client flew in to Phoenix and wanted to ride around houses, I said, would you put another realtor in your car and ride them around for 3 days with you and the client? He goes, no. I said, well, quit letting that coyote come to your rabbit party. So the other thing I'm going to say about your plan is this is your coyote party, and you're inviting rabbits. Don't go to a coyote party looking for rabbits. You make your own party, and you are providing the carrots. And control that and influence that. And understand if you don't have a warming process with investors, your chances of success are almost zero. Why does somebody do business with you? Why does somebody do business with you? Let me give you a 3-pronged formula. Like, respect, logic, and reason. Like, respect, logic, and reason. So you got to be likable, and you got to be respectable. They have to respect that you have some knowledge in the business, that you have something to show them that's good and that's clear and that you're clear about it, right? Note examples are an excellent way to start building respect. And the next thing is logic and reason. They have to see how it works, right? So you're educating investors, but you're not over-educating investors, right? Don't confuse them. Show them how it works, and show the simplistically of showing them how it works is the best way to do it. I'll tell you a little lesson I learned. When you start saying yield to a room full of doctors and lawyers, 90% of the time you're going to confuse them. Now let me tell you how that works. They're all looking good and smelling good, and they're sitting there with their arms crossed like this, and they go, interesting, interesting, interesting. Interesting means they don't understand. Listen, if you've ever failed at this, trust me, you're ever looking for a guy that's ever failed at this, you're looking at him. I've failed at it a bunch of times. I just have finally kept doing it long enough that I figured out. Make it clear. I found out what every investor wants to know is how much they're going to get back. Not yield, dollars. Is that right, Pete? They want to know how much money they're going to get back. Yield confuses them, dollars don't. If you invest $100,000 over the next 10 years, you're going to get $130,000 back. You're going to get $140,000 back. You invest this, you're going to get this back. It's going to be like mailbox money. It's going to come into you. It's going to look like this. That is the most satisfying thing to a passive investor I've ever seen in my life. I use the term interest on your investment. I don't use the term yield. I found out that yield was a disconnect word and interest on their investment was a connect word. So make a plan. Understand there's people with uninvested funds that need to do something with it. There's big opportunities. You just have to figure out how you're going to nurture that audience. You're going to make them like you, respect you, and you're going to show them logic and reason. And you're going to stay warm in developing the investor. You're not expecting a check the first time you meet them. You're expecting a check 7 months from now. It's a plan. It's a strategy. It's a system. It's a process. And if you don't build a plan and lay out that plan, am I right, Dave? It won't happen. This guy did it, and he was very anxious to start because it didn't look like it was a house of fire to start with. But then all of a sudden, the more investors come, all of a sudden they just grow, right? It just happens. And it took you about 8 months to make that happen, didn't it? And you had to ask for the sale. It's a great point. Is this helpful to you? Y'all have a great day.